Good afternoon, ladies and gentlemen, and welcome to the Institutional Real Estate Europe webinar. My name is Arno van Grondelle. I'm the MD for Europe at Institutional Real Estate Inc., and I will be your host today. IREI organizes these webinar series to give you an insight of what you can expect at our VIP conference that will be held 11 to 13 of February in Hotel Arts in Barcelona. If you want to attend VIP and did not register yet, you can visit irei.com and click on events or wait for the notification that you will receive in your text message webinar screen at the end of the webinar. Well, thank you all for joining us today. We're going to talk about valuations and opportunities post-Brexit. What real estate sectors and strategies are at risk, which sectors and strategies offer new opportunities, what types of property are being overly discounted with regards to valuations, what are common misperceptions, and what are some future challenges that investors should be aware of and following. Well, although Brexit did not happen yet, and will probably be extended again, we will talk about the effect Brexit can have on valuations and if it will create opportunities or not. Therefore, we have three specialists in our panel today who will do a small presentation first, and after the presentation there will be room for questions. Please note that this webinar is interactive and it allows you to send in your questions, which we randomly pick at the end of the panel discussion if the time allows. To move on, we would like to introduce today's panel. In the room today, we have Jesse Freitag Axelrod, Managing Director, Advisory and Consulting for Green Street Advisors. We have David Inskip, Head of UK Strategy and Research for CBRE Global Investors. And we have Charles Golding, Associate Director, Tangible Asset Valuation for RICS. Welcome, gentlemen. Welcome to the room. We would like to invite Jesse to start his presentation first, followed by David and then Charles. Jesse.
Thank you very much for the kind introduction, Arno. What I wanted to start with IRR, and I know IRR is a concept that is used widely across the real estate industry, but everyone defines it a little bit differently. So I thought it would be a good idea to start with that. And really, when we're talking about IRR at Green Street, what we mean is an unlevered, after CapEx, perpetual hold concept. So if you look to the top of this slide, the top graphic, we have a buildup of what I call an economic cap rate. What is an economic cap rate? Well, it starts on the left-hand side of the exhibit with an initial yield after deduction of operating expenses. And then there are a few adjustments, the most significant of which is a deduction for capital expenditures. So we deduct a CapEx reserve. When we talk about CapEx, what we mean is a sinking fund type of concept, CapEx that should capture the full life cycle burden of a like-for-like portfolio or a single property. So it is not the CapEx that will happen within the first 5 or 10 years, but rather the CapEx that might accrue to the landlord over 30 years or 40 years. What will it cost to replace the elevators? What will it cost to do brickwork? What will it cost to replace the roof in 40 years? And how much would I have to put away on an annual basis as a percentage of my net rental income to make sure I have enough money for that CapEx? So that's what's described in the top side of this graphic. The bottom is a simple IRR, a simple DCF layout, starting with that after CapEx cash flow. We grow that for a medium-term period, so call it 5 years, at which point, as all IRRs, as all DCFs, we calculate a terminal value. As you'll all be aware that the terminal value oftentimes includes more than 70 to 90% of a property's value. So we place great care on trying to estimate that correctly. I think the fundamental difference between our IRRs and most IRRs that I've seen calculated is that we don't inform that terminal value by an exit cap rate. We don't try to guess what might I be able to sell this property for in 5 years. Instead, we try to estimate a long-term growth rate. So how will the cash flows, the after capex cash flows, grow into perpetuity for this asset class? And at Green Street, it is typical that we would think that cash flows will grow less than inflation into perpetuity. Looking at this next exhibit, what we've put on the slide is a cross-sector comparison using even that IRR methodology that I outlined. So an after capex perpetual hold unlevered IRR, that's what you see in the middle column, and we deduct from that a local 10-year government bond yield as the fixed income alternative. So the IRR less that fixed income alternative, the sum of that is the metric by which we inform what is an attractive investment and what is an unattractive investment. And that's the ranking that you see down the rightmost column there. And if you look at what does this ranking of sectors inform? Well, it really says up top, the alternative sectors, UK self-storage, UK student housing, they're looking very attractive. Residential, indicated here in beige color, also looking quite attractive. And by contrast, looking at some of the traditional sectors, retail and office, less attractive. What do public market returns or public market metrics, what does the REIT market say about this cross-sector picture? Well, I think in many ways it mirrors what I just alluded to on the private market side. So if you look to the extreme left of this chart, you see UK shopping centers. UK shopping centers trading at very deep discounts, where the black bars indicate our NAVs, Green Street's NAVs, and the beige bars indicate appraised valuations. On the flip side, you'll see some of the alternative sectors. So again, UK student housing, you see UK healthcare, and you see UK student accommodation at relatively strong premiums. And what this suggests to me is that the public markets endorse these sectors. They say grow to these sectors, whereas they would say shrink, do not grow. Prospects are challenging in the shopping center, in UK shopping centers. So having spoken then a little bit about the returns that we see in private markets, the returns that we see mirrored in public markets, finance theory might suggest, if you leaf to your finance textbook, higher returns should be associated with higher risk. Is that what we're seeing? Well, in this case, what we're doing is we're looking through the lens of a very specific risk, the risk of a no-deal Brexit. And indeed, I think we see the opposite of that finance textbook suggestion. Some of the alternative sectors, so UK student housing, UK self-storage, those sectors that I suggested have stronger return prospects, have strong public market premiums, are those sectors which we anticipate would be less impacted in a no-deal Brexit scenario. And indeed, on the other side of the spectrum, what would be most impacted? I would say one of the most severely impacted sectors might be UK regional retail. The economic shock from a no-deal Brexit that would affect less affluent regional UK consumers. No offsetting help from maybe a weakened sterling that would boost tourists who typically don't shop in regional shopping centers. The dual impacts of that, we believe, would impact UK shopping centers disproportionately. Thank you.
Thank you, Jesse, for your for sharing this. Jesse, your IRR methodology, it doesn't use an exit cap rate, but instead a long-term growth rate to estimate the terminal value. Why is that? And how do you estimate your long-term growth rate?
Arno, thank you. Yes, so that is true, and I think it is one of the main differences in our approach. Essentially, we find it quite difficult, maybe impossible, to have any conviction in what a cap rate might be in 5 years. So in a typical IRR, your terminal value, however you calculate it, if it's a 5-year IRR, if it's a 10-year IRR, your terminal value would have a significant proportion of the overall NPV. So what we're trying to do is we're trying to minimize the guesswork. Again, we don't want to guess at a 5-year or 10-year out cap rate. And instead, we want to inform that terminal value by something that we think is more readily estimable. What is that? That's long-term growth. Now, we are still estimating. We are still guessing, if you want. But we find it's more of an educated guess than if I were to try to say, what's the cap rate going to be? Why? Because we have significant long-term data that would say, how have these asset classes or adjacent asset classes that we can triangulate from, how have those asset classes performed over a long time period? Have they performed in line with inflation? Have they performed above inflation? And what we've seen from these long-term time series is that most sectors, and I'm talking about like for like portfolios competing with new properties coming on, aging asset bases, that most of those portfolios will underperform inflation. It is a rare flower for Green Street to say you will grow above inflation. There are such sectors, US manufactured housing, certain residential sectors, supply insulated sectors, we believe have a chance of growing above inflation into perpetuity. Does that answer the question?
Sorry. Yes, thank you very much, Jesse. David, Charles, would you like to, do you have a question for Jesse, or do you want to make a comment?
I think it's a really interesting methodology that's being talked about there. I fully agree with the long run rate of growth being something that you can have a better foundation for estimating with an exit cap rate. But we do have to remember, of course, that still long-term growth rates can change. I mean, if you look at retail in the UK, then getting to grips with how those long-term growth rates change quickly is really important. And I think sometimes investors can underestimate how quickly those things can change.
Great. Thank you for that, David. You're up next for your presentation.
Okay.
Let's pull up the slides. There you go. Go ahead, David.
Thanks, Arno. And I'm really happy to be talking to you all today. I'm going to touch more on some of the current market conditions that I'm seeing. Undoubtedly, Brexit, among a number of other things, is causing considerable uncertainty at the moment and creating lots of differences of opinion, I would say. And as an investor, I would say that differences of opinion create opportunities, although I acknowledge that they also create a headache for valuers. But when the differences of opinion are too wide or uncertainty too great, investors can decide to just sit on their hands and activity slows. And that's sort of what we're seeing at the moment. The first chart I'm showing here shows that over the first 9 months of the year, investment volumes in the UK have been down by about 25% year on year, although still close to their long run average. To be clear though, the market is certainly not awash with unsold product. Caution is impacting sellers as well as buyers, and a lot of transactions this year have been taking place off market or are only being selected to offered to select parties. The thing though is, how can we be sure that this is a Brexit impact, or is it wider factors? I mean, after all, volumes have been down elsewhere in the world as well. Well, looking at a different set of data, I can shed some light on this question. The second chart here shows the capital liquidity scores as produced by Real Capital Analytics. Rather than just looking at volumes, these scores also consider factors such as the number and diversity of investors that are active, and whether key players are in the market at the moment. And this data definitely suggests something UK, or rather something London specific, is going on. While other major European markets are seeing liquidity above average and towards the top of their historic ranges, liquidity in London is below average. Now, I have confidence that London will remain a very liquid market over the medium and long term, but in the interim, this lack of evidence does complicate valuation, as we're talking about today. But there isn't one story that holds true across all of the sectors, though. Each has its own dynamics. That is always true to an extent, but it is particularly true at the moment. Undoubtedly, it is the retail sector where valuation has become most difficult. And here, Brexit is certainly not the main factor at play. The pricing expectations of buyers and sellers are still some way apart, and movements in valuation are only closing the gap slowly. Let's take shopping centres as an example. Here, CBRE's valuation team advised that yields on good secondary shopping centres have moved out almost 200 basis points over the past 2 years and are still trending weaker. However, the yields on the shopping centres contained within the MSCI quarterly universe have moved by less than half of that. Now, I admit there's a difference in the sample there, but the two have historically had a similar yield. So it seems properties are being held on the books at valuations above what can actually be achieved in the market. If we look at rents, the speed at which ERVs will drop seems to have hit a floor or a cap at about 1 to 1.5% per quarter, as shown in the second chart here. However, other evidence suggests that ERVs are down at least 20%. So I asked the question, are we looking at 4 years of adjustment to get to realistic rent expectations? I certainly hope not, but either way, that transition will be painful. Again, I admit I'm mixing data sources here, and there will be lots of variation by location, but the point I think is still valid. And this all adds up to illiquidity in the sector. And in this environment, there will be some mispriced opportunities, but you need to have real conviction to be going after them. Now, the past few years have presented almost the complete opposite situation for industrial property in the UK. Investors have fully bought into the structural story that e-commerce and reconfiguring supply chains will lead to greater demand. But I would say actually at one point they've bought into this too wholesale, applying it to the whole sector rather than specific assets and locations. The first chart here shows that even as property investors in general became more risk averse since the referendum, which is shown in a push up in the spread of secondary yields over prime yields, the opposite was true in the industrial sector. Here, investors needed less and less compensation for taking on risk. Valuers actually struggled to keep up with the increasing prices being paid for weaker industrial assets as the market moved very quickly. But in fairness to the valuers, transaction prices for weaker assets overshot, and we have seen them correct somewhat in recent months. Prices at the prime end of the market have been much firmer though, and now pricing overall looks better aligned to occupier market prospects. In the occupier market, some things have changed. Industrial rental growth has been consistently strong over recent years and well in excess of historic averages. But other things haven't changed, like the relative performance between prime and secondary assets. There is still a wedge between the rates of rental growth generated by each, and this hasn't narrowed, as shown by the second chart here. In recognition of this, investors have become more discerning in 2019, really assessing which locations and assets will continue to generate rental growth. And the prime secondary split actually hides a lot of nuance here as well. Performance will also vary by types of industrial product and by different types of location. For me, the biggest question is always, is there any constraint on the land supply? So if that was a historic story of divergence between investment market and occupier market, there is also a similar divergent story in the London office market today. I already mentioned that recent liquidity in London has been less than normal. I do think that is partly to do with a lack of stock as well as demand. However, there are some investors, largely overseas investors, that are out of the market at the moment. So while yields have continued to compress across continental Europe, that has not been the case in London. The first chart shows how that has created attractive relative pricing in London. Of course, whether you really view that as attractive pricing or just accurately pricing the risk is subjective. It depends on your view of Brexit. To try and answer that, I would take some guidance from the health of the occupier market. Following the referendum, take-up in central London was surprisingly resilient, but lease events and consolidations were an important driver, which meant net absorption was negative and rents fell. However, in 2019, demand for space has actually been really strong. Net absorption is back into positive territory, and that has resulted in prime rental growth. This is what's being shown on the second chart here. So really, we have to ask ourselves, is the occupier market or the investment market right? Only time will tell for sure, but I do lean towards the occupier market. So in conclusion, there's a lot of uncertainty out there, and Brexit is a big part of that. This makes it a difficult time for valuation, especially while transaction volumes stay low. Although in my opinion, the biggest issues are in retail, which is not Brexit driven. But overall, lots of differences of opinion means plenty of opportunity.
Thank you for that, David. Well, we already saw this in the presentation of Jesse. Do you see any opportunities in retail, or is that too early?
I think there are opportunities. It depends upon what you're looking for as an investor. The fear around the sector does mean that at the moment, investors aren't really differentiating between retail of different quality. They're lumping everything in together, the best assets and the worst assets. So I'm sure there will be some mispriced opportunities in with that. Really, it's all about how sustainable or how replicable the income is. Can you be confident that your rent has fully rebased? Now, looking at market rent stats or indices, you would conclude definitely no. But actually on the ground, from letting activity, you will see that there are some locations, some assets, where maybe a CVA, for example, has reduced the rent by 30%. And now at that level, there are actually other retailers looking at it, suggesting that maybe that income is a bit more sustainable. So yes, I think there are a few opportunities out there, although maybe not many for core investors.
Okay, thank you for sharing. Jesse and Charles, do you have any questions for David, or would you like to make a comment?
Really interesting presentation. I just wondered whether there were any macroeconomic conditions in addition to Brexit, or any structural changes, and whether these are separate and how they are reflected.
Yes, so I mean, as I say, there's a lot of uncertainties out there at the moment today. I've focused in on trying to isolate what might be due to Brexit, but I think really we have to remember that the UK is a relatively small economy, a very open economy, and so there are bigger headwinds, if you like, out there at the moment. The world economy is slowing. We've seen that. We've seen the response from central banks cutting interest rates with expectations of more cuts to come, and that also reflected in fixed income markets. So while I've tried to highlight some of the Brexit impacts there, yeah, I think you do have to take a step back sometimes and look at the global picture as well.
Maybe an observation that I might add, and also to concur with David. So I feel presently it's the whole of retail is oftentimes thrown into one basket. And just to be clear, I don't think the returns that we're seeing are compelling anywhere in retail, really. That is a statement that I believe in. But I think some retail is much riskier than other retail, much less insulated, much more susceptible to further shocks than certain retail. So contrast, for example, central London high street retail, portfolios like Shaftesbury's or like Capital and Counties, really central London under-rented retail. Whatever happens, you will find a tenant there. Whatever happens, there will be foot traffic. In a Brexit scenario, you may see a benefit from a weak sterling and unabated tourist demand. and we've seen that. We've seen that. We have some historical evidence of that. Whereas, look at, let's say, a regional shopping center, maybe in a competitive market, now facing a strong e-commerce penetration and further growth in the UK, which is already Europe's most highly e-commerce penetrated market. Now, I see the risk profile for those two types of retail very, very differently.
Okay, David, do you want to?
No, I mean, I completely agree with Jesse's comments there. Yeah, interesting that he's put the Brexit spin on it as well there, and remembering how movements in the exchange rate beneficial to one part of the market will actually be hurting consumer spending power and retailer margins in other parts. So yeah, something to be aware of there too.
Thank you for that. We will now go over to the presentation of Charles, but before we do, I want to encourage our audience to send in your questions. I mean, this is interactive, so please send in, and we will ask them after the panel discussion. Charles, I see you're ready. Go ahead, the floor is yours.
Well, hello, and thank you for having me with you online today. My office is actually adjacent to the UK Parliament and Supreme Court, with all the protests that go with that. So if a brick does come through the window, I will just sort of duck and carry on. There's also a bagpipe player who usually starts up about this time, so I may have a musical accompaniment later on as well, you'd be pleased to know. I work in the professional standards team at RICS, and we write and update professional standards and guidance on valuation and related topics. This afternoon, I'm going to cover how traditional valuation principles interact with a world of changing dynamics, rules, and philosophy, and how standards development across a range of disciplines, including valuation, adapts to reflect these. As you might expect, this is going to be more of a qualitative than quantitative analysis, as seen in the slides of my colleagues in this presentation. My first example is flexible workspace. Now, in more traditional times, real estate was a reasonably straightforward investment, long, steady leases on upward-only terms. Following the previous financial crisis, and within many cycles prior to that, landlords and brokers have for some time looked for ways of subdividing space more innovatively. But in many real estate markets now, people are talking about a restructuring outside normal cycles, as we've seen. And part of that is the desire for investors and operators to share their rewards, but also the risk of investment in real estate. And this has led to some questions in standards terms about what exactly is being invested in. Valuers must start from first principles. What's being valued? A lease, a freehold, a business, a brand? For what reason? Financial reporting, tax? And from what perspective? An internal strategy or objective, or an external view? The valuation solution to each of these may be very different. If market value is to no particular owner and worth is to a particular owner, there are challenges with the sort of setups common in the flexible workspace market: joint ventures, management agreements, turnover top-ups. My answer to these conundrums is a rather basic one. Business value is business value, it's separate. A market view of real estate value must be objective. It cannot be too heavily swayed by a business's individual performance. However, one should not ignore operational performance if it is down to the real estate and the market in which that real estate operates. Real estate and locations that are particularly suited to flexible workspace should have that reflected in their value. Some market stakeholders think operational income has become so stable and to a degree predictable that greater reliance can be placed on models that focus on estimates of operational income, or from an operator's perspective, the actual income. There has been a revolution in the way that we work in the last 20 years, but a significant proportion of changes, open plan offices, working from home, are still confined to corporate structures. Some of the SME market require no contracted workspace at all. Now, whilst flexible workspace operations have expanded extensively in recent years, they're not yet dominant in the wider office market, and in fact make up a relatively small but very much growing part. A flexible workspace incorporates everything from traditional business centres in secondary locations to hybrids of co-working and corporate lettings in prime metropolitan centres. Furthermore, some progressive operators have significantly more service provision and related income from this. Into this, there is the issue of brand and goodwill. For some operators, this makes up a significant part of their appeal, but again, might not be attached to the real estate asset. The challenges of the market mean no standard methodology is adopted, although some have called for greater consistency and have asked for valuation standards that encourage this. In addition to changes in dynamics, standards have to reflect changes in rules. An example is the proposed rule change leading to a review and update of principles and therefore standards, which recently occurred in the UK around the FCA's consultation and new policy on illiquid assets and open-ended funds. The FCA have proposed a requirement for an AFM to temporarily suspend dealings in units of certain funds where the independent valuer has expressed what's known as material uncertainty about the value of the movables that account for at least 20% of the real estate in the scheme. Given the implications of this rule change, it's important for valuers to distinguish material uncertainty from general valuation and market uncertainty. A degree of uncertainty is a feature of all valuations, but there is a point when this materially affects the ability to produce a meaningful answer. This will be an unforeseen event, a situation of such magnitude, it goes beyond the normal boundaries that a valuer can acceptably work within. RICS's global advice around material uncertainty is proposed to be changed effective from early next year, following communications with key stakeholders, including the investment fraternity to whom I'm speaking with today. The third element of change I thought important to flag was how shifts in philosophy, culture, and public opinion interface with valuation and therefore standards. Nowhere has this been more so than sustainability and environmental and social governance. I read an FT Market Insight piece yesterday predicting that by 2029, a company's ESG rating will be as important as its credit rating. The benefits of better sustainability and ESG are spoken of usually in this longer term view. Valuers have the tools and capability to analyse the risks around future events, as we've seen. But what can be harder is isolating and pinning down the effect of individual factors. This can be heightened when looking at the component parts of ESG. A specific environmental factor, such as energy saving, may be more quantitatively measurable, whereas social factors, much more ethereal, difficult to pin down. It is not the role of the valuer to nudge the market and society into behavioural change, but that does not excuse the valuer from properly analysing and reporting on sustainability factors. Sustainability regulation and statute is changing, usually hardening globally. The market and investors are signalling changes in practice and expectations. Global standards across the boards are taking these into account. For example, RICS are looking at changing our global professional standards to include an explicit requirement around sustainability, as referred to on the slide. Now, crucially, this is to be undertaken without a presupposed assumption of an effect on value. It is a changing world. New approaches to and perspectives on valuation are developing at pace. Standard setters, we need to keep up and stay relevant. And part of that process is engaging with investors such as yourselves. And I welcome questions from you today.
Thank you, Charles, for sharing this with us. Charles, how is flexible workspace impacting the valuation process?
Yeah, it's an interesting question, and it often comes down to the perspective of who's involved. There are operators in the market who don't actually own outright any real estate at all, and there are then some who own all of their property freehold. In common with a number of modern real estate investments, flexible workspace is seen to hold value beyond its bricks and mortar, its beyond it steel and glass. Some of this may be a misnomer. Certain firms have the dressing and outlook of tech companies, but are in essence landlords in the same form as traditional serviced office operators have always been. Where a simplified analysis of a rent and yield may be adopted in the standard office market, and we've seen more detailed approaches in the presentations today, the deeper analysis is sometimes taken in respect of flexible workspace. Valuation outcomes may be triangulated and more highly tested for sensitivities around variables, for example. And there's also the issue of most valuers are familiar with rental income when valuing real estate, but unless they work in the leisure sector, are valuing hotels and the like, they may not be as familiar with income from services, and therefore they need the experience and competence to take that into account. Now, as the market for flexible workspace expands and adapts, lenders, investors are asking more questions about valuation outcomes and the assumptions that are made naturally.
Thank you for that, Charles. Jesse and David, do you have a question for Charles or want to comment?
On the flexible office space, I think it's really valuable, the steps forward that are being taken there in clearing up valuation practice, because it is a tricky sector for investors also to be looking at. But I think it is one that is part of the market now and here to stay, only with further growth to come, regardless of what may happen to the odd specific operator here or there. I think also we have to think about what that means for us as office landlords more broadly, and it certainly has changed expectations. And maybe if I draw back to one of Jesse's points earlier, when you think about the capex, that is an assumption that people don't always give enough thought to, then maybe that has really shifted what is required to have an office that will continue to be in demand in this new world.
Yeah, maybe a comment on the flexible office sector from my side. It's been an interesting ride over the last few years, certainly. So I think there was a rah. It's the best thing since sliced bread mentality that's now been substituted by a deep skepticism and sort of a trashing of this sector. And I think neither of those elements, neither of those viewpoints are completely correct. Firstly, we've had flexible office operators since many moons. IWG Regis was in the early 2000s faced very similar challenges as did WeWork more recently. So in one way, it's nothing new. So that's, I think, one thing to highlight. The other point that I think is on the positive side, in many ways, the new flex office concepts that have arisen, for all their problems and for all the valuation challenges associated with them, have highlighted where the office industry will go, what tenants are demanding, and what types of operators will be required, what new skills, what new service offerings will be required to cater to the tenants of today and tomorrow. So in many ways, I feel the current malaise in the flex office sector is temporary, and there will be a dialectic by which this current negativity, this current problem will transform into the beginning of a newly conceived and client-facing sector, and so I hope that ultimately the office industry will improve thereby.
Charles, you want to react on that?
No, that's exactly right. We shouldn't be too positive or too negative. I think there are certain perceptions and trends that may have been that overplayed in the market. The service income, the the co-working element, and what can be important is the ratio or the mix of types of tenants. The also corporate lettings are important in this market as well. Private offices offering a range of services and provision is seeing good outcomes, and not just focusing on what might be the trend elements.
Thank you. Well, we had all three presentations, so thank you very much for that. I want to continue with some questions. David, you covered the traditional property sectors, but what about the alternative sectors?
Yeah, that's a great question. I think the alternative sectors at the moment offer lots of opportunity, but not necessarily opportunity that has gone unnoticed. I mean, we saw a pretty clear trend in the hierarchy of sectors that Jesse showed us earlier, and we've seen investment volumes in the alternatives in UK as a percentage of the total breaking records this year. So I think there are not just Brexit, but there are investors out there nervous about where we are in the cycle, thinking that we're probably in quite a mature phase of the property market cycle. And they're looking for some structural themes rather than cyclical themes, things like residential, things like healthcare. And also, I think it also can tie into something that Charles was talking about, the whole ESG agenda, which really has gone up investors' list of priorities. It's gone very quickly from being something that was an appendix in investor reporting a couple of years ago to something that's really front and center of their thinking. And areas like healthcare or affordable housing offer structural drivers and a chance to achieve those ESG targets.
Thank you. Jesse, Charles?
Well, certainly from our perspective, the alternative sectors, and it's not sort of one class of assets. It's various different types of property types combined in that alternatives group, offer very compelling risk-reward propositions. And if I had to throw a dart at which part of the real estate investment spectrum would I like to focus on, it would be the alternative sectors. By and large, yields remain higher. By and large, growth, medium term and long term, is higher. And many of these sectors, I think, are insulated from certain of the macro demographic risks to which office, to which retail, to which even industrial are susceptible. So in many ways, it's not sort of a trade-off. Hey, I'm going to go for a higher return sector and also accept higher risk. I'm going to go to a higher return sector and get a lower risk profile. The real problem for some of these sectors, I think, is how do you get liquidity? So if I told you to put £1 billion into UK self-storage, you'd have a hard time. So I think in many instances, the challenge with alternative sectors is first to understand the risk profile and to sort of accept that, to get that through your investment committee. Hey, this is a good idea. But then secondly, how do you assemble a portfolio? Do you develop it? How do you cobble it together? Are you going to go down to a very granular level and purchase these things? So I think the challenges sometimes are not necessarily on the risk, but on the liquidity.
Thank you for that. David, your base case outlook assumes an orderly Brexit, but what changes with a no-deal Brexit?
Yeah, it's a very good question, and the sort of question that we are spending a lot of our time thinking about at the moment. I think there will be a degree of repetition in my answer, though. So secondary retail, regional retail in the UK is the area that I worry about the most. It's already struggling, and the last thing it needs is another spike in inflation that comes from further depreciation in the value of the pound, which would both hurt consumer spending power and retailer margins. So that would be my biggest concern. But there, as we've already touched on, there are other parts of the market which actually stand to benefit from sterling depreciation. For example, hotels or central London retail, where they're very dependent on tourist spending. Maybe even student accommodation to an extent, depending on immigration controls and regulation, what happens there. I think the other conventional sectors, offices and industrials, much more marginal in my opinion. I think in those cases, it really comes down to understanding who your tenant is and what they're actually using the property for, because some activities will be more vulnerable than others. But I think we, like a lot of other people, have shifted away from that view of central London offices being particularly vulnerable to mass relocations, because we simply haven't seen it. And London continues to be a place where people want to live, and that means there's a huge talent pool for organizations looking to recruit.
Okay, Charles, I see you nod. You want to react on this?
No, absolutely. We face wider challenges. Whatever happens with Brexit and certain assumptions about the market, we don't hold them to be true from a standards perspective. What does the evidence show? And that's very much what we should be concentrating on.
Thank you. Jesse, to get back to you, alternative sectors screen strongest in your private market expected return analysis. And they also seem to be trading at the highest public market premiums. Why is that?
So I think the answer to that is not one answer. The alternatives, again, they're a bucket of different heterogeneous property types, and they happen to all screen pretty favorable. So let's say, looking at a couple of different buckets, say UK self-storage, why is the return there so favorable? Well, I think you have significantly higher yields than you would say in office or in retail or in industrial. You have very strong medium-term growth. In the UK, that's a specific point because occupancies dropped off very strongly in the 2012-2013 recession. And so you have some upside there just from getting those occupancies to stabilize. And indeed, we have some evidence that that's happening. So if the occupancies are somewhere in the 80s now, we think they can go somewhere to the low 90s. So UK self-storage, higher yields, higher medium-term growth, and then because the penetration of this asset class is so low still, let's say 1/10 versus the US, we think that there are years to come where the asset class becomes known by a larger group of would-be investors, returns become evident, so the penetration, we believe, will increase. Will it get to the US? Who knows? But in short, you have very comparatively higher yields, you have strong medium-term growth prospects, you have, we believe, strong long-term growth prospects, and very low capex. So self-storage is sort of the darling, if you want, and therefore has screened very, very strong at the top of our list for many, many moons now. I think you have other asset classes where there are different reasons. UK student housing, I think, also has some secular tailwinds and is insulated from Brexit in many ways. They're looking at a high-quality portfolio, a Russell Group portfolio, let's say. Those waiting lists are long. The impact if EU students were to drop off that list, the list would shrink a little bit. But of the total UK student population, only about 6 or 7% are from the EU in the first place. And again, as that sterling weakens, will the proposition of going to a UK university, will that look more appealing to, say, an affluent Chinese student? We think so. So in many ways, I think student housing, also a very favorable return. Resi, much lower ingoing yields. But again, I think long-term growth prospects compensate for that. So I think you have a little bit of you need to look at the sectors individually, but it usually boils down to what are the ingoing yields, how do the growth prospects look, and what is the capex? By contrast, you look at retail, you look at office, lower yields, lower medium-term growth, really high capex, which combined makes for a less favorable return.
Thank you for that. Alternative sectors, yeah, they show higher returns, but aren't they much riskier?
So I don't want to paint too broad a brushstroke. I think that is certainly, so if you were to go headlong into UK student housing, can you get that really wrong? Certainly can. I think if you go into a market where you're overbedded, or the unis are lower quality, you can make deep mistakes, even in an asset class whose overall risk profile from our perspective is maybe moderate. But what we've seen, and we did a we showed today our Brexit analysis. What we've seen is that the alternative sectors, by and large, for sector-specific reasons, appear more insulated from some of the risks that we all see coming. Whether it's Brexit, whether it's demographic trends, whether it's macro shocks, it seems like some of these sectors, UK healthcare, UK self-storage, student housing, appear like they have sector-specific tailwinds that would also insulate them from risk. If you look at public markets, and you say take sector-specific REITs, how have they performed over a really long time period? And we can look at this in the United States, where we have certain sector-specific REITs, only student housing, only self-storage, and have operated for 20, 30 years. And let's take a look at those returns, and let's take a look at, let's say, annual volatility as a proxy for risk. What you see is sort of the opposite of the finance textbook. It shows those sectors with higher returns, not always, but often, also have lower volatility. We're talking about net lease, we're talking about self-storage. Again, these sectors, really high returns over the long term, much lower volatility. So no, Arno, what is higher return is not necessarily higher risk.
Okay, well, thank you for that. I want to go to Charles. How does valuation standards help reduce risks for all stakeholders?
As a standard setter and regulator, we can sometimes be seen as sort of market stiffening in a way, the antithesis of the market, but standards allow comparability, ultimately a local, international level, whether that's international financial reporting standards, international valuation standards. You can clearly analyze and measure a portfolio that spans across the globe and for a number of purposes. They provide a mutual understanding, a language both to the provider of valuation services and the end user of those services. And it sometimes breaks down assumptions and colloquial sort of knowledge. The parties know exactly what they're referring to because it's defined within the standard. Risk is substantially reduced when there's an opportunity for redress and a framework for regulation as attached to standards, and that can give comfort to investors. And finally, the probably most importantly, then why I picked it last, the ethical principles that are the foundation of many standards build trust between service providers and end users, and reduce the risk of misunderstanding and at worst illicit practice.
Thank you. Jesse, David, do you, is either one of you want to comment on that? Then I will move on. I will stay with you, Charles. What are strengths and weaknesses of current sustainability and ESG measurements?
Well, I'm going to talk in very, very general terms and appreciate that we have standards out there on this. So probably as you could accuse us of being guilty of our own standards and measures, but generally we see them at a macro, at a corporate or portfolio level. But the valuer has to break this down and often will be valuing an individual asset and then needs to reflect the ESG and sustainability on that asset. The individual asset may be harder to do. Measures don't often show that. Awareness of the issue, it's helped raise it at the front end. So people are thinking more about capturing the performance of a property through development and management, so that when it comes to be bought and sold, leased, the data is available around the performance in those terms. There can be a reliance on government or regulators, third-party institutions to define the measures where stakeholders can't agree amongst themselves what the measures could be. And this can lead to measures being defined by those not familiar with the market or with an agenda that works against it. However, the strength of third-party involvement is at least it sets some rules by which a measurement can be made, and it allows data to improve.
Okay, thank you. I would like to stay with you because we have a question coming from the audience. For retail assets, how are valuers accounting for CVAs when considering asset values? Are valuers assuming rents will return to their previous levels once the CVA period has ended?
Unfortunately, I'm not going to give a market or economic view today, talking from a valuation standards perspective, but certainly standards expectations are that valuers look at items objectively, refer to core evidence, stand back and look, and don't rely on a literal interpretation of the terms of a lease or a simplistic valuation approach. Apologies that that's quite generalistic, but I can't give a sort of market view today.
Okay, thank you for that. And can you imagine that we still have 4 minutes left? Time flies when you're having fun. I think we got some great insights today, and let's see what will happen at the end of the month. And these are exciting times. Before we leave, I would like to give our panel the opportunity for a final takeaway. I will start with you, Jesse.
Thank you. From my perspective, I think it's very interesting to have 3 gentlemen from very different pieces of the property industry concurring, overlapping in their opinions in many ways. And I think it's hopeful that we concur on the negative and on the positive trends. Looking forward, we will come through Brexit. We will still be sitting in the UK, and I think then, once the uncertainty is behind us, hopefully we will see a positive, a strong resurgence, where again, divergent but overlapping viewpoints can help fuel further growth. So thank you very much, Arno, for allowing me to participate here. A very interesting panel, very valuable.
You're most welcome, Jesse. David, your final takeaway.
Thanks, Anna. So yeah, as we've covered, I mean, there's plenty of uncertainty out there, Brexit being one of them, but I do feel that that is creating differences of opinion. It's creating opportunity, and I don't want to predict what the final outcome of Brexit will be, but if it isn't too disruptive, then I think a lot of people will look back on this period we're in right now and look at it as a bit of a missed opportunity to put some capital to work.
Thank you for that. Charles?
I think the focus of political matters may mean that we're looking at things, looking at trends in the shorter term, and perhaps being overly positive or overly negative around things. But when we stand back and look objectively and understand clearly what it is we are valuing, then we can get appropriate answers from there. Thank you.
Thank you for that. Jesse, David, and Charles, thank you very much for your vision, insights, and perspective. This webinar is a good example of what you can expect at our VIP conference that will be held 11 to 13 of February in Hotel Arts in Barcelona. You will now receive a short message on your webinar screen with a link to the VIP agenda and registration page. We have a great program lined up for you, so please don't hesitate to sign up, and we will be looking forward to meeting you in Barcelona. For our next pre-event webinar on November 6th, we will welcome Norbert Bol, CIO of Sweco Capital Consultants, Harvard Hawkland, CEO and co-founder of Spacemaker, and Arnie Sriskandaraya, Managing Director at Roundhill Ventures. We will then talk about understanding impact and opportunity of emerging PropTech trends. For now, thank you very much for watching, and hopefully you will join us again on the 6th of November. Don't forget to register for VIP, and see you then. Thank you very much and a happy Wednesday.